We're diving deep into life insurance, cutting through the jargon and complexity. We're going to look at the 4 ways to deal with risk and clarify the 2 main types of life insurance policies. Life insurance, it's a critical risk management tool. We're also going to run through the exact formulas I use with my own clients to help them understand what their options are. But stick around, I've got something for you. So you can answer these questions yourself and understand how high net worth individuals save thousands on their payments. It's the key to maximizing coverage and reducing the amount that you have to pay for it. Let's jump in. Every decision you make has risk involved. We deal with it in 4 main ways. First, just accept the risk. Acknowledge it, choose to handle it yourself. Think of it this way. When you go to pick up dinner, you get in your car, you accept the risk, you might get in a minor accident. The second way to deal with risk, it's just to take steps to reduce it. On your route to dinner, you drive on roads you know. You stick to the speed limit. That's going to reduce the chance that you get in an accident. The third way to deal with risk, well, that's easy. You avoid the risk altogether. You're thinking about getting dinner and you look outside and it's starting to rain. Pay a little extra to have your food deliver, and there's no chance of getting in an accident now. And the fourth way, the most relevant to today, you transfer off that risk. This method, it shifts that financial burden over to somebody else. This is where insurance comes in. You purchase the policy, and the financial burden of the risk, well, that falls on the insurance company, not you. For example, you're going to carry car insurance. That's going to help you cover the cost of replacing the car and any large medical bills in the event of an accident. For life insurance, though, risk transfer, well, it protects the biggest asset you have, your future paychecks. So what is life insurance? Well, at its core, it's a simple contract. You're going to pay the premiums, the monthly payments. In return, the insurance company, they pay out money to whoever you choose when you pass away. When that death benefit is paid, it can serve many critical purposes. The first, generally the most important, well, income replacement. It ensures that your family can continue to maintain their life and pay the bills once you're gone. It can also provide debt and liability coverage. Your policy could be used to pay off things like the mortgage, car loan, or even a student loan. It's going to prevent those things from falling on your survivors once you're gone. Now it can also cover final expenses, things like funeral costs or cremation costs. Life insurance, it can also be a powerful tool for funding education if that's important to you. And lastly, for high net worth individuals or business owners, it's an essential estate planning and business continuity tool. Creating liquidity for, say, estate taxes or funding a buy-sell agreement so the business can continue without them. If any of these apply to you, then you'll need to know what type of insurance to buy. That can often get overwhelming for people because honestly, there's a whole lot of options out there. But let's simplify the choices. There's 2 primary types of policies. You have term policies and you have permanent policies. Let's start with the easier one. This is called term life. Term policies provide coverage for a specified period. It could be 10, 20, or even 30 years. It's a pure death benefit. It means you only get paid if you die inside that term. That's pretty much it. Policies are straightforward, and the advantage here is their simplicity and affordability. You can buy a relatively large death benefit for relatively low cost. The monthly payments here, they generally stay the same for the entire policy. The disadvantage is that coverage ends when the policy ends. So it's important to calculate how long you need the coverage for. And that brings us to permanent policies. They are what they sound. Permanent life policies are designed to last for your entire life. They have 2 components. They have a death benefit and they have a cash value. The premiums here, they could either be level or they could be flexible, but they are paid across your life. Death benefit is guaranteed, and a portion of your monthly payment, well, that goes to funding the cash value of the policy. That cash value, it can grow over time, and in some cases, it can be invested in hopes of higher returns. Policyholders here, they can take loans or even withdrawals against the cash value of the policy. But there's always a catch. Permanent life policies come with much higher fees and premiums than term policies. And the investment options available, they often have lower returns than other investment choices. So now that we know what we can buy, the crucial next step is, how much do we buy? And remember to stick around. At the end, I'll show you how to structure your policies so you can save thousands on your premiums across your life. So how much insurance do you need? There's a couple of different ways to look at this. First, we have the income replacement method. This one's pretty simple. You calculate how much annual income your family needs to continue their life. Multiply it by the number of years that you need to support them, and there you have your number. For example, if your family needs $80,000 a year for 15 years, then your target coverage is $1.2 million. This method is just going to ensure that your loved ones have enough funds to continue their lives after you're gone. Next up, we have the debt and final expenses approach. You add up all your debts and any expenses that would need to be paid out upon your death. So you could look at your mortgage balance, a car loan, credit card debts, funeral costs, and even estate settlement fees. Let's say you have a $300,000 mortgage, a $20,000 car loan, and you need $15,000 to cover your funeral. Well, your total is $335,000. This method ensures that your debts are clear and they don't fall on your loved ones, but it doesn't leave anything left over for them to live on after that. Next up, we have the poorly named human life value method. This one's a little bit more complicated, but a calculator combines all your future earnings. It looks at your current salary and how long you're expected to work, and then it figures out what those payments are worth in today's dollars. That sum, it's just called the present value. Finally, we have the D.I.M.E method. This one's just a checklist. It looks at debt, income, mortgage, and any future education costs. It's typically great for parents of young kids who are looking to make sure their families can stay in their home and continue life after they're gone. Here, you just list out all your debts, including the value of your mortgage. Use the same calculation from the income replacement method, and then you come up with a number of what it would take to send your kids to college. You add all those up, and then you have your number under the D.I.M.E method. If you want to run these calculations for yourself, I have a free calculator with all of them on it, linked in the description below. Now the calculator, it's a great place to start, but I always recommend people talk with a licensed agent and a financial planner before making a final decision. Now, before you run off and calculate your numbers, there's a couple important things to consider here. Remember to quantify the value of a stay-at-home parent if it applies to your family. While they may not earn an income in the traditional sense, replacing everything they do for the house, like childcare, cooking, even home management, that's all very costly and it has to be covered in the event of their death. Second, account for your full insurance picture. Make sure to account for any coverage that you may have through an employer plan. Consider the chance that you might lose access to this policy if you're thinking about leaving your job or you're in a volatile industry like tech or sales. Third up, what money do your survivors have access to once you're gone? I want you to think about things like bank accounts and investment accounts. I'm not talking about liquidating your family home. These accounts could offset the total amount of coverage that you need to pay for. And before we wrap up, let's talk about the game-changing strategy I promised you. This is where we move from theory to efficiency. Your ideal coverage, it's probably not going to be a set it and forget it number. It can change as your life does, and it leads to a specific strategy that can save you thousands over your life. This is called layering policies. You can actually stack multiple life insurance policies right on top of each other. For example, you could buy 2 policies, each for $1 million of coverage, but one's for 10 years and one's for 20 years. The $2 million of coverage during that first 10 years, well, that covers the risk of having to pay off all your debts while your children are young. And that mortgage balance is the largest. The remaining $1 million of coverage over the last 10 years, well, that just covers the risk of you losing your income for your survivors until your retirement age. This strategy, it allows you to match the high cost of coverage with the years that you need it the most. It helps you keep your overall premiums lower than buying a single policy for the full term. And it prevents you from having to shop for a policy later when you're older and the insurance company, they view you as a higher risk. The truth is, no single formula fits everyone. Your ideal insurance coverage, it depends on your unique situation, and it's essential to revisit it as your circumstances change. Things like life events, income variations, debt levels, they all impact how much coverage you need. Don't forget to download the free calculator below, linked in the description. And if you're ready for a fiduciary review of your unique needs, Glow Financial Planning is a fee-only firm. What that means is we work for you. We don't sell you products and earn a commission. You can schedule a free consultation on my website, and that's linked in the description below. Thanks so much for watching. I'm Jordan Drinkhouse. Subscribe to my channel for more videos on securing your family's financial future, and I'll see you in the next one.